Hello, everyone. Gina here with your April 8th weekly market update. It's been a few weeks since I have come to you with an update, so I wanted to hop on today to give you just a slightly less technical, more big picture recap of where we are at, but more importantly, what we are and have done about it. So stick with me. I promise I'll get to the good stuff. Before I do, just want to recap, as most of you already know, last week the reciprocal tariffs were announced Wednesday afternoon. In most cases, they were far higher than anticipated. And this sharp rise in tariffs is expected to slow economic growth. That's the problem. That would contribute to higher cost of products, which leads to more or higher than expected inflation, and therefore a much higher likelihood. Again, none of this is known for sure, but higher likelihood of a recession. In addition, there is just a considerable amount of uncertainty that US businesses are going to have to navigate if the tariffs remain in effect. As we know, markets don't like that. Uncertainty is what they like the least. Um, so there's really just an extremely high level of economic uncertainty, the unknown effect on corporate profits, stocks, and higher than expected inflation. That is really why we experienced such a steep sell-off in stocks last week. So here's what you need to know about what we are doing about it and what we have already done. So first of all, take a deep breath and don't panic. We are long-term investors, not day traders. And we have implemented a strategy and a plan for each and every one of you that has built in the inevitability of downturns in the market. This is not a surprise. The core and foundation of what we do is construct a portfolio from a plan that is systematically designed to be appropriate for not only your time horizon and income needs, but your risk tolerance as well. So what I mean by this is if you are retired, for example, and taking income from your portfolio, depending on how much income you need and other sources that you may have, we've appropriately constructed your portfolio to have a buffer of conservative positions or cash to safeguard on the inevitable downturn. So, for example, if you happen to be 60-40 investor, that means 40% of your portfolio would be in safer money to allow us plenty of time to ride out volatility on the downturns. That being said, I want to also remind you that we are active money managers, and this is somewhat unique. So yes, of course, we will ride out a dip or a correction, but unlike many other advisors, we don't feel like you need to go down with the ship on something that's more than a normal, healthy dip or downturn. If you recall, weeks ago, we did anticipate this larger than expected downturn as a possibility. Therefore, for most, if your allocation has swayed off course due to 2 years of incredible equity growth, we rebalanced back to the appropriate allocation, which locked in gains and raised money on the defensive side. In addition, we also sold even more for many of you over the past couple weeks to raise more cash and really batten down the hatches. The other benefit of this is that we now have cash and dry powder available to us when it's time to take advantage of this as a buying opportunity. So I know that it's easier said than done to remain calm in this extremely emotionally and politically charged environment. However, remember, you are in this for the long term, and it really is times like these that it is so incredibly crucial to not make an emotional decision when it comes to your investment portfolio. As always, if you have any specific concerns, though, please reach out. Otherwise, we'll talk to you next week.